Hey everybody, welcome to Blockworks. This is Alf speaking. I'm the author of the free newsletter, The Macro Compass, and the guy behind the Twitter handle at MacroAlf. I'm going to be collaborating with Blockworks from now onward, so just subscribe to the channel if you want to hear more of these interviews. Today, my guest is Brent Donnelly, who's the president of Spectra Markets and a former FX trader. Hey Brent, how are you doing?
Hey, I'm good. Yeah, it's been good to meet you in person. I see you on Twitter. We always cross paths, so good to see you in real life.
Amongst other things, you're an FX expert. So I wanted to pick your brain on this dollar weaponization story. So the background here is that the US has been using through sanctions, basically, has been avoiding that the Bank of Russia access their FX reserves denominated in dollars. And by the way, Europe is doing the same. So there is a narrative developing out there that, every emerging market country or any other country that has accumulated dollar reserves might actually have a problem going forward, and therefore they might trust the dollar less. So what's your take on this dollar weaponization story?
So I definitely think it's relevant in kind of like an intellectual way, but I also think that it's very difficult to trade depending on your time horizon. So I think people have to be cognizant of the timing mismatch between talking about what could be like a 25-year theme or a 10-year theme or whatever, and then the relevant, actions that people should be taking in the market. So the fundamental issue, there's two issues with the whole story, which is, yes, it makes sense that as a central bank holding a lot of US treasuries, especially China, you see what has happened and you say, okay, I thought this was money, but maybe it's not really money. Are my FX reserves safe? And the answer is they're a little bit less safe than you thought they were. However, there's a lot of sort of things that go the other way. So first of all, this happened with Iran already. So much of what has happened to Russia kind of happened similar. It's not exactly the same, but SWIFT and all that. There were some similarities. They de-dollarized. Russia had already de-dollarized. Mostly that happened in 2018. And the ability for China to de-dollarize it it's just very challenging because of the lack of alternatives. So the reason that the US has been the reserve currency is, there's many reasons, but one of them is just the deep capital markets and deep bond markets. And those don't exist elsewhere. And like you said, the sanctions are coming from Europe too. So the euro is not going to work. Generally when people think about alternatives to the US dollar system, China renminbi, the yuan tends to be in the conversation now. Obviously, China can't hold its own reserves in its own currency, so that doesn't make sense. So then some people think the release valve will be gold. And I think that does make sense. Like there's an argument that essentially what we're seeing is that like fiat currencies aren't quite what we thought they were. They're being printed in unlimited quantities. They can be shut off. You can pull a switch in the SWIFT system and essentially demonetize what we thought was money. So I think the argument that gold should gain market share in terms of central bank holdings is valid. But having traded with central banks for, since I started in 1995, they're slow moving organizations that are very, very cautious. And like, I'm not an expert on China, but I know the gist of their strategy. It tends to be one of their edges is that they can play the super long game. So to me, what that means is there's kind of this permanent bid for gold. But so maybe if you had it as 5% of your portfolio, maybe you want to slowly go to 8 or something like that as an investor. But I think the issue that people are having now is they're long gold on this, which is a pretty substantial sounding story, like Bretton Woods 3 kind of story. But their stop loss is like $150 below the market. And I don't think it's that kind of trade. I think it's like a long-term investment kind of trade. But there's so many other factors that drive the value of the dollar and the value of gold other than reserve manager behavior. And that, like I said, I think reserve managers generally will be very, very slow to make changes. So to me, it's an interesting theme, but I think the one really big way that people misunderstand this is to think that it's going to have a negative impact on the external value of the dollar. Like the dollar is going to collapse because of this story. And I would say that that's probably not the case. And we have a lot of evidence of, there's been a decent amount of de-dollarization that has happened over the years. The percent share of dollar holdings has gone down a lot in terms of the magnitude. Russia basically went to $0, et cetera. And the external value of the dollar is very strong because it's influenced by many, many, many other things. So maybe like the ceiling for the dollar is lower and the floor is lower because of this. But it's not a reason to like exit all your U.S. assets or your U.S. dollar holdings. I just don't think it's that kind of story. It's a very, very long-term story. People like to talk about the death of the dollar because it's fun to talk about. And because I've been doing this since 1995, it's a theme that's just been around pretty much my entire life. And so one time, just for the heck of it, I went and looked at all the Time Magazine and Economist covers that like say death of dollar or like the debt bubble's about to explode or, that the U.S. hegemony is over. And honestly, it goes back to 1968. So it actually goes back even before like the gold window stuff and Bretton Woods and all that. It's a persistent fear, which is grounded in a lot of reality. There's a lot of crazy things happening all the time with payments like pension liabilities and all that kind of stuff. But like I said, I remember in 1985, it was like the pension liability bomb that's about to blow up. And they put up this big sign in Times Square, the U.S. debt clock. And I mean, that debt clock is still there. So I think all these things are important and relevant, especially as we went to more of like a MMT kind of style of fiscal and monetary post-COVID. But I would just caution people not to overreact to something that is like, it's like trading demographics or whatever, right? It's important and it should be part of your investment process. But also you need to understand the cyclical factors just dominate all these structural things unless you have an extremely long time horizon.
So Brent, on this demographic stuff, I want to pick it up from there. I attach a lot of value and do a lot of analysis on demographics. And it's one of the reasons why I've been a bond bull for the last, 10 years since I've been in this business, basically. But if Powell tonight would come out and say, I'm going to dump all my treasuries in QT to the dealers all tonight, then fuck demographics. I mean, 30-year bonds are going to spike to the roof in terms of yields. I mean, there are cyclical drivers and long-term drivers. And so people tend to mix them up very often. We're going to cover this part later. I want to ask you a bit about your risk management and how do you think about long-term and short-term trades. But let's talk for a second more about this dollar story. You mentioned before that you are thinking in terms of probabilities. So while there might be a bit of a higher probability that, there's a lower dollar ceiling, let's say, and maybe the floor has changed as well, you always think about what's the alternative. And you slightly mentioned, but I want to hear more about why is actually the dollar chosen to be the reserve currency at the moment? What are the qualities, the features that the reserve currency should have to be elected as a reserve currency?
So the main thing that is required is deep capital markets, because you're just talking about whatever, say China's got 4 trillion, a trillion here, a trillion there, say whatever, 10 trillion of reserves. I don't know what the number is, but something like that. Those reserves don't want to buy a whole bunch of physical gold and buy warehouses to store that gold in and then hire a bunch of security guards. So, there's a limit to different assets and how much of it you can buy. So like even a very liquid market like Canada, China would have trouble getting all the Canada that they want in their portfolio because like they can buy all the like Ontario and Saskatchewan bonds they want. Those markets are just not big enough, right? And so same with New Zealand. And so those currencies and those markets tend to, represent, say, 3% of holdings, 2% of holdings for a lot of central banks. And so that's like in this world that we live in now, this wasn't always the case, but in this world, that's really like the number one thing. And then after that, like, generally what they want is some kind of return on assets. So, there was kind of an aversion to some of the European assets for a while because they were negative yielding. But I would say much more important than yield and return on assets is just liquidity. And then there's sort of more philosophical things, like generally in the course of like the Dalio timeline all the way back to like 1400 or whatever, it's a country with that's self-sufficient, that has a strong military, that's like the global superpower is kind of generally tends to be the reserve currency. In terms of like thinking about probabilities, the mistake I think people make is generally thinking that the change is the same as the level. So like the level of US military superiority is still very high, even if it's declining. The level of US innovation vis-a-vis the rest of the world is still very high. And so like the US, is self-sufficient in food, self-sufficient in petroleum products. The US is still like a very strong, I'm Canadian, by the way, so it's not home bias. The US still has like a lot of strong features, but most of those features are in decline. And so the question is like, how long does that decline take? And generally my answer to that question is that the decline takes longer than you would think. It started in 1971, as with breaking the gold standard. And so I guess my caution to people would be that this is an interesting intellectual thing and it's relevant for investors, but it's also something I think you have to keep in mind that is like an extremely slow process. And, there's a lot of entrenched systems that support the dollar as a reserve currency. And, China pricing oil and yuan and doing some trades with Russia isn't going to change that overnight. So that answer to your question then means like, okay, what are the alternatives? And you can go, okay, well, China bond market is small, Japanese, you can start going all around the world. And that's part of the reason for gold is that first of all, if the point of these countries is to protect themselves from being labeled as a hostile nation, so like that's what happened with Russia, right? They're labeled as a hostile nation, and so they get cut off from SWIFT or from the dollar system. Now, it doesn't, there's not that many places to go if you're believing that, because generally like the US has a lot of allies still, right? So, where you can't really go to Europe, you can't really go to yen, those are two of the biggest economies in the world that you just crossed off the list. So the list just gets really small, and then you go, well, if we're going to do this, we better do it over the course of 10 years. And, I actually think the very end game could end up being a bipolar system or a tripolar system even, where CNH is part of it and Bitcoin is part of it and the US dollar is still a bigger part of it. And then you have these regional areas where people are trading commodities for Bitcoin or trading commodities for CNH or for yuan. But it doesn't have to be so binary. Like so people like to talk about like the death of the dollar kind of thing. It doesn't have to die necessarily. It can just be like a slow and gradual like decline of the usage. And then all of a sudden, like when I'm 99 years old, I go, well, dollar isn't as dominant as it used to be. There's little pockets of places where everyone just trades everything for Bitcoin. And I think that's what will eventually happen. But, I'm not holding my breath and cutting all my dollar assets because of it.
Well, thanks, Brent, for making sense of a probabilistic scenario of how this, reserve system could work. Let's move to a more short-term topic on FX, right? Because there is something cyclical going on as well. And I know you have a view on euro dollar. Can you elaborate a bit on the short-term view on FX?
Sure. So actually, it's funny because coming into this year, the story was central bank divergence. So it was going to be like Fed doing a lot, hiking and QT. And then ECB and BOJ kind of on hold, probably not going to do anything because of a whole bunch of reasons, mostly like structurally low inflation, but a bunch of other stuff. And then if you look at a chart of euro dollar, it basically has gone like this. There's been like 4 separate narratives. And so 2 of them were ECB normalizing faster than expected and ECB hikes. And, obviously European rates moved a lot. But the underlying, so usually the anchor for FX is the interest rate differential between two countries, as you know. I'm just saying this for the viewers, but so that has actually just been pushing more and more in favor of the dollar. So the original thesis of, Fed's going to be a lot more hardcore than the other central banks on normalization has been correct, but people have got whipsawed so many times that the position ended up kind of getting washed out. And now you kind of have a setup where interest rate differentials are making new like highs for the dollar, lows for the euro. So like 5-year Germany, US is at 2.25% or something. That's a big difference, right? And so now I think we're going to actually get a meaningful dollar higher trade over the next 4 weeks, especially as basically people were very focused on QT and the Fed and all that, but then everyone kind of took their eye off the ball because of Russia. So like generally my framework is that the market can really only focus on one thing at a time. So the market was focused on the Fed, and then the market got worried about Russia and Ukraine. And generally I find that geopolitics trigger a lot of fear that flows through to the market, but the actual economic impact is not always as big as the fear trade kind of suggested it would be. And that's kind of how this has played out. Like we got the big short squeeze, but I think the whole Russia-Ukraine thing is mostly a red herring for risky assets. And fundamentally, what's most important is the level and direction of liquidity. So I remember seeing David Tepper on CNBC in 2010, and everyone was bearish at that time. Like, I don't know, S&P was at 1,200 or something. And literally, like, everybody was bearish, except for a couple people. And he's like, liquidity is increasing. You got to buy stocks. I don't care how bad things look, this and that. You got to own stocks. And Dave Zervos actually has been kind of like that too. And they were right, like however bad things looked at that time, liquidity, the delta of liquidity has been the simplest and most effective framework for measuring the direction of risky assets for the last 12 years, right? Like, and so now, the tide's coming out, QT's starting. And the crazy thing is, like, everyone knows this, liquidity on or off kind of thing. But people got so distracted, I think, by Russia that I don't even think the market's short now. Like, market got squeezed so badly that I feel like, the liquidity is about to come out in May. May could be QT. And don't forget, like November, December, we weren't even talking about QT. It was like something that was way down the road. I think Waller or somebody mentioned it in December. That was the first. And then it became kind of like a thing in January. So now it's like it's April 6th. We're about to do QT in May. The speed with which this is all happening is just absolutely mind-boggling. So now I think you're going to get a real dollar trade. And I think dollar yen is kind of like the sneak preview in that, like, we just went from 115 to 125 in a snap. And people weren't really ready for that because dollar yen had been dead for so long. And generally with G10, you have like the regime of this is boring and nothing's going on and euros just oscillating. Those are a major part of G10 FX is just the nothing's going on kind of regimes. So then I think you have to be ready for the like, okay, something's actually going to happen regime. And I think we saw that in dollar yen and we're about to see it in euro. So I think euro goes to around 105 into FOMC, which is May 4th. And I think people are kind of numb to, people are so used to a dovish Fed and a slow moving Fed that I think people are kind of numb to what's going on a little bit. Like the speed with which they pivoted since they dropped transitory is pretty mind blowing. Like it makes sense given 7% inflation and whatever. But I think people are still in this mindset of like, oh, the Fed, the Fed's overpriced. And in this part of the cycle, generally the Fed follows the pricing anyways. Like, so no matter how much pricing there is, like the market gave them 25 in March, so they hiked 25 in March. Now the market's giving them 50 in May, they're going to hike 50. So, and generally that's historically like rates drive the tightening generally, not the Fed, but the actual market. And then the Fed ratifies it by doing it. So the argument that like too much is priced in, I generally don't find very useful in tightening cycles, because if the market prices more, the central bank will do more, especially the Fed when they're so far behind the curve. And the other thing too, just one last thing on this, is that the other reason people kind of don't believe it is that, like, if an alcoholic has a bottle of Jack Daniels in their hand and they're saying like, dude, I'm getting sober, I promise you don't really believe them. And that's what the Fed was, right? So they were saying like, we're now taking inflation seriously. Brainerd said it when she was renominated and all that. But yet they were still buying assets up until 6 weeks ago. So like, you don't believe that they're going to be serious about tightening because they're still buying assets. They have this belief that things that they've guided in the past they need to do, or it'll hurt their future forward guidance credibility. And what it's actually done is really hurt their tightening credibility, because you can't say like, hey, we're going to tighten and we're worried about inflation at the same moment as you're buying assets in the assets in the market. It makes no sense. So I think that's another reason why people are like, yeah, okay. But like everyone, basically, a lot of people are just like, yeah, I get it, but a lot's priced in, 7 hikes. How can they hike more than that? Okay, sure, but people were saying that at 4 hikes and 5 and 6 and 7. Like that's kind of the way. So so I think the dollar does well across the board, and especially against euro, because the thing with one big sort of story in FX right now is terms of trade and capital accounts, and so that is a big problem for Europe with the energy crisis. And then also, I think, so most of the downside kind of surprises, I think, would come, most of the surprises in Euro in the next like 6 to 8 weeks would be to the downside, I think, as well. Like the French election, man, I'm not that excited about that. But the ECB kind of saying like, hey, we got to hit the pause button here. There's a lot of demand destruction. We're getting worried about, the way the curve's inverted, whatever. They can always fall back on the idea that there's so much demand destruction, or like ZEW survey is so bad that like the job has already been done to destroy the demand side and prices will come down, and like it's transitory, basically, they can say. So I think that's a downside risk to euro as well. And then the third downside risk to euro is an escalation of sanctions. So the more graphic and unpleasant the video is from Ukraine, the more the political pressure kind of moves from, well, they're the only place we get our energy, is kind of like the argument now, to like, we have no choice. We don't want to be, we don't want to be financing these atrocities that everyone's seeing on TV and yelling at us about. So I think there's 3 potential catalysts that could push euro lower. And you don't even need those, because the rate story is just moving enough that the path of least resistance should be down anyways.
Short-term cyclical move into May, euro dollar down to 105. That's your base case. But then before that, we talked about a potential for long-term, de-dollarization across the world. So the question I want to ask you is, how do you split in your head, and how do you approach a long-term trade and a short-term trade from a risk management perspective, being a former trader and still a risk taker?
Right. Yeah. So, I mean, I still do trade, but I'm not a market maker anymore. But so I think this is a really important question for everyone on the whole entire spectrum, from like day traders to like 10-year time horizon investors, is knowing what your time horizon is and being good at that, and then being able to identify why you have an edge in that slot. So, like bad traders turn their bad trades into investments. Like that's one of the kind of jokes, right? Is that like, well, it went down 20%. I guess I'll put that one in the investment pile. So my niche is trading. So like my time horizon is basically 1 day to 1 month in terms of the trades that I take. But my approach is way bigger picture, because the way that I look at it is, like, let's say the equilibrium price now in any asset is the sum of all the information that, that's knowable in the world or whatever. Then you have to kind of have a pretty good idea of what all that information is, so that as new information comes, whether it matters for the price. So that's kind of my framework, is like, okay, I understand the global macro. I know why people are bullish Aussie. And I know why people are like, haven't been short euros lately because this, and this. And then I know how to respond to new information. So for me, that makes risk management much easier. So mostly I use technical analysis, or I even use like simple things like, based on the time horizon of my trade, if it's a 1 week trade, I'll just take average daily range times 2, and that's my stop loss. So like, I think the risk management can be relatively simple. And in trading, it's easy because if you don't have risk management, you'll end up blowing up, and you won't make money. So you're kind of forced to have a good risk management system. I think as a longer term investor, it's more difficult because the temptation is like, oh, I loved it at 10. When it goes to 8, I want to buy more. And then when it's at 4, I want to buy, like, triple down, like people did that with Lehman Brothers stock. Yeah. And so, but then again, also most of the research shows that using stop losses as an investor reduces returns because it creates suboptimal exits. Like, you're selling low and buying high sometimes. So I think like for investors, it's much more difficult. And I think for investors, I still think everyone should use stop losses because I think it keeps you intellectually honest. Like I know you're much bigger picture than I am, but you still use stop losses because that's the proof that you're wrong. And actually, an interesting thing when I was researching, like, does technical analysis work, is like an interesting subject I find, and I write about it in my books a lot. So I've gone into the rabbit hole a few times, and basically my conclusion is technical analysis does not work. Like, you can't backtest Head and Shoulders and all that stuff. However, there's also research that shows portfolio managers that use technical analysis outperform those that don't. And it seems like a mismatch, like a cognitive dissonance kind of thing. But I think it actually makes sense because people that use technical analysis have a point where they are forced to admit that they're wrong. Whereas a portfolio manager that doesn't is going to tend to be adding to losing positions and like, not cutting losers, but adding to them. So for me, generally, I always have a take profit and a stop loss on every single trade I do, no matter what the time horizon, unless it's options. And I'm pretty good at sticking to it now. Like, I actually think that is one of the most important things for succeeding in trading is just sticking to your plan. Because once you have risk on, you tend to be more emotional and biased, and like all the cognitive, like Kahneman, thinking fast and thinking slow, those biases I feel like are 10 times more powerful when you have risk on, because you have like, especially trading, you have physiological responses to the risk and all that. So you tend to act in a lot more biased way. So I feel like setting parameters ex ante and sticking to them is the way to go on risk management. And then you don't also have to white knuckle every trade and constantly be reevaluating. You're just like, okay, this is my trade, these are my parameters. And then you just let the thing cook, and hopefully it's a delicious treat when it comes out of the oven.
It's invaluable, Brent, to hear these things from a guy who has traded for decades, right? And I also recognize that the intellectual honesty part is by far the most important, both if you're a short-term trader and if you're an investor. I mean, being a short-term trader, it's simpler from a risk management perspective, correct me if I'm wrong, because you set up your system ex ante, you size your positions, you have your stop losses, you have your entry, you have your system. If you can stick to it, then it's mentally easier, let's say, to get around with it. Being an investor, medium to long-term investor, it's a bit more of a nuanced exercise. But despite that, I think intellectual honesty can do a lot for you because, as my mentor used to say, Alf, when facts change, you change your mind, even if you're an investor. So you have to continue to ask yourself, every now and then, has something really changed in a material way to change my underlying assumption? And as long as you are intellectually honest, you'll be able to also take losses if you're an investor and avoid those losses turn out into a, wipeout event like Lehman Brothers, right?
So one thing I think that has really helped me evolve as a trader is just embracing the idea of being wrong. Like, it's, you're going to be wrong X amount of times. And that number X is going to be pretty big over the course of a career. And
True.
It's good to just say, you know what, yeah, I'm wrong on this. And, I'm going to cut and I'm going to move on. And I think it's harder to do when you're young because probably like you have a bigger ego generally when you're young, or like I definitely did, but I think generally that's a rule. And also you haven't experienced the pain of being wrong as many times. So one thing actually that helped me with that a lot was collecting data on my trading, because then I started to get a good idea for what my win rate was. And then like I know my win rate's basically 50%, but the way that I make money is my wins are bigger than my losses, obviously. And so if you know you're going to be wrong 50% of the time, it doesn't really hurt that much when you're wrong. You're like, okay, wrong again, like big flipping deal. What I actually get upset about is when I don't stick to my parameters and change my stops and all that. But I've kind of grown out of that by mostly automating everything. So I would say like embracing the, not that you're going to be wrong all the time, but embracing the possibility that you could be wrong. And then I think that also opens your mind to what the alternative hypothesis is. So like if you're always kind of thinking, yeah, you know what, I might be wrong on this, then that's like the right mindset for allowing new information that goes against your idea to come in, right? Because like confirmation bias, which I'm sure most people are familiar with, but confirmation bias is a very strong human trait or human bias. That means that when you have a view, you allow all the confirming information into your brain, and you reflexively, without realizing it, subconsciously block the non-confirming information. So when you kind of accept, on a more like deeper level that you're going to be wrong a lot, then you are also a lot more open to like, okay, why might I be wrong? Like what's the scenario? What's the alternative hypothesis where, I think euro's going down, but what's the hypothesis where euro goes up 500 points? And then you start thinking, okay, now I can list like what might happen in that case. And then hopefully you can say, okay, I don't really think those are high probability likelihood things or events or catalysts. So I'm good. But then sometimes if you're good at exploring the alternative hypothesis and you have a decent network, you get feedback and you're like, yeah, you know what? That thing that I didn't think of that someone just told me is actually true, and maybe I shouldn't be short euros. And you're able to just, you don't really like feel this strong emotional attachment to your trades. It's more like this long series of probabilistic experiments that, are 50-50, but they pay 2-to-1. And you just keep running that experiment and you're going to make a lot of money.
Well, Brent, I'd like to add something on risk management, but this was a primer, really awesome. If the audience here at Blockworks wants to find more about you, I know you've written an amazing book that I've read, by the way. So feel free to tell people where to find more about you.
Sure. The easiest way is to just go to my website, which is Spectra Markets. So it's Spectra, like with an A, markets.com. And so most of the stuff is on there. And then the book is called Alpha Trader. And that's on Amazon. People can grab that as well.
Yeah, well, Brent, I can only thank you for being here for this first interview I've done for Blockworks. There would be many, guys, so subscribe to the channel if you haven't yet. Brent, thanks again for being here. It's been a pleasure to have you as a guest.
All right, thank you, Alf, and I'll hit subscribe right now myself.
Ciao, Brent. See you soon. Ciao, guys.
Thank you.